Imagine you wake up tomorrow with $500 million. Not in a bank account with your name on it. Not in a brokerage you can log into. Nobody sends you a statement. Nobody calls to congratulate you. In fact, if you tried to prove you had this money, you couldn't. But it's yours. Every dollar of it. This isn't a thought experiment. This is actually happening. Right now. To millions of people. And the mechanism behind it is one of the most quietly consequential things in modern finance, something most people walk past every single day without knowing what it is or what it means. So let's talk about unrealized gains. What they are, why they matter more than almost any number in the financial world, and why the conversation about taxing them is a lot more complicated, and a lot more revealing about how money actually works than anyone on television will tell you. Start with a simple story. In 1994, a guy named Jeff Bezos quit his job at a hedge fund, drove to Seattle in a Honda, and started selling books out of his garage. He owned a significant chunk of that company. Let's say, for the sake of argument, he bought his shares for essentially nothing. A few cents on the dollar. Because it was his company, and it was worth almost nothing. Fast forward 20 years. His stake in Amazon is worth somewhere north of $100 billion. Here's the question, at what point did Jeff Bezos become a $100 billionaire? The obvious answer is, gradually, as Amazon grew. But the tax answer, the legal, IRS-certified answer, is, he hasn't become one yet. Not until he sells. That's the rule. In the United States, and in most developed economies, you do not pay tax on money you haven't received. You pay tax on realized income. Cash in hand. A stock certificate sitting in a vault, even if it's worth $100 billion, is not income. It's potential. And potential, under the current system, is not taxable. This is called an unrealized gain. And the gap between what an asset cost and what it's worth today is the single largest reservoir of untaxed wealth on the planet. We're not talking about small numbers here. In 2023, the Federal Reserve estimated that total unrealized gains sitting in U.S. household accounts, stocks, real estate, private equity, were somewhere in the range of $40 to $50 trillion. To put that in perspective, the entire U.S. federal budget is about $6.5 trillion. The unrealized gain pool is roughly 7 federal budgets, just sitting there, growing quietly, completely outside the reach of the tax code. Now you start to understand why this matters. Let's slow down and explain the mechanics, because this is where it gets interesting. When you buy a share of stock for $10, that $10 is called your cost basis. It's what you paid. It's on the books. The IRS knows it. You know it. Now the stock goes to $100. On paper, you've made $90. But you haven't done anything. You haven't sold. You haven't touched it. That $90 exists, it's real in the sense that if you called your broker tomorrow and said sell, $90 would show up in your account. But you didn't call. So for tax purposes, that $90 does not exist. This is where people either nod along and move on, or they stop and think, wait. That's a little strange. Because the person with the $100 stock is meaningfully wealthier than they were. They can borrow against it. Banks will lend against unrealized gains. Hedge funds will use those shares as collateral. You can live off loans secured by assets you never sell, which means you never trigger a taxable event, which means you can be, in the practical sense of the word, extraordinarily wealthy, and pay remarkably little in income tax. This is not a conspiracy theory. It is a documented strategy. It has a name. Some financial planners call it buy, borrow, die. You buy appreciating assets. You borrow against them to fund your lifestyle, and loans are not taxable income. Then you die. And here's where it gets genuinely strange. When you die, your heirs receive those assets at the current market value, not your original cost basis. The gain effectively disappears. It is never taxed. The $90 you made on that stock. If you hold it until death, it evaporates from the tax code as if it never existed. This is legal. This is widespread. And this is one of the primary mechanisms by which generational wealth compounds across decades without ever passing through the revenue system. So now the political question becomes obvious. If there's $50 trillion in unrealized gains sitting in America, and a meaningful portion of it will never be taxed under the current system. Why not just tax it every year? Mark everything to market. If your stock went up, you owe tax. Simple. This is the unrealized gains tax proposal, and versions of it have been floated by progressive economists and politicians for years. The Biden administration put a version of it on the table. Senator Ron Wyden has proposed variations of it. Wealth economists like Emmanuel Saez and Gabriel Zuckman have modeled it extensively. And on its surface, it sounds straightforward. Rich people have money. Tax the money. Problem solved. But here's where the math gets uncomfortable, and where the debate becomes more interesting than either side usually admits. The first problem is liquidity. Not every unrealized gain is a stock you can sell tomorrow. A lot of it is locked up in private companies, in real estate, in illiquid partnerships, in family businesses. If you own 40% of a privately held manufacturing company that's been in your family for 60 years, and someone tells you the company is worth $200 million, you now owe tax on that valuation, even though you haven't seen a dollar of it, and selling would mean breaking apart something your family built over generations. The IRS would effectively be forcing you to either liquidate assets or come up with cash from somewhere else to pay a bill on money you've never received. This is not a hypothetical. It is one of the central arguments against mark-to-market taxation, and it's taken seriously even by economists who support wealth taxes in principle. The second problem is volatility. Markets go up. Markets go down. If you tax someone on a $100 gain in January, and the stock falls back to $10 by December, do they get a refund? What happens to the revenue projections? The administrative complexity of building a system that tracks every asset, values it annually, assesses a tax, and then reconciles it against future losses is genuinely formidable. And the third problem, the one that doesn't get enough attention, is valuation itself. Stocks traded on public markets have a clear price. But the majority of the $50 trillion unrealized gain pool is not in public stocks. It's in private assets, where value is a judgment call. Who decides what your private company is worth? Who decides what that piece of commercial real estate in Phoenix is worth this year? And if the answer is, the government hires appraisers, then you've created an entirely new bureaucracy whose decisions will be contested in court for decades. None of this means the status quo is defensible. It clearly isn't. The ability of the ultra-wealthy to compound assets through borrowing, avoid realization events indefinitely, and extinguish gain at death is a structural feature of the tax code that has no coherent philosophical justification. It exists because it was written by people who benefit from it, and it persists because the people who benefit from it have significant influence over the people who write these things. That much is not really debatable. But the mechanism to fix it is not as simple as taxing the number on a screen. Here's the bigger picture, and this is where it gets genuinely interesting. We're living in an era where the gap between financial wealth and economic activity has never been wider. The stock market is not the economy. The assets sitting in the unrealized gain pool are not circulating. They're appreciating. And the people who hold them are not spending them into the economy in any meaningful proportion to their scale. A person with $500 million in unrealized stock gains is not consuming $500 million of goods and services. They're consuming maybe a few million. The rest is compounding. Growing. Floating above the real economy like a separate layer of reality. And the tax code, built in an era when wealth was primarily earned income, wages, salaries, dividends, was not designed for this world. It was designed for a world where rich meant you made a lot of money every year. Not a world where rich means you own things that grow quietly for decades without ever producing taxable income. The economy changed. The tax code didn't. And the result is a system where a nurse paying $40,000 a year in taxes and an asset manager sitting on $4 billion in unrealized gains are, in a very technical and literal sense, being taxed on the same basis. Realized income. Except the nurse has no choice but to realize her income every 2 weeks. And the asset manager has every incentive, and every legal tool, to never realize his. This isn't a left or right argument. It's a structural observation. The system is working exactly as designed. The question is whether the design still serves any coherent purpose. So let's come back to where we started. You have $500 million. But nobody knows. Because it's not in an account anyone can see. It's in shares of a company you started 20 years ago. Or a piece of real estate you bought when nobody wanted it. Or a stake in a private fund that has quietly tripled. The wealth is real. The math confirms it. But the tax code doesn't see it. The income statement doesn't reflect it. And until the day you sell, if you ever do, it doesn't exist in any official sense. This is the quiet architecture of how extreme wealth accumulates and persists. Not through dramatic tax evasion. Not through offshore accounts in movies with briefcases. But through a mundane, technically legal, perpetually unrealized status that the code was never built to capture. And the unresolved question, the one that actually matters, is this. At what point does paper wealth become real wealth? When you can borrow against it. When you die and pass it on. When you finally sell. And whoever controls the answer to that question controls, in a very real way, who this system is actually built for. Nobody has answered it yet. Not convincingly. And until they do, the 500 million stays invisible.